go more than 10 and ask for a few more minutes. That's what Nicole does. Okay, well, she says, look, it is now 10 o'clock. We are still gathering. We can use just another few minutes to be ready. I think that's what Nicole normally does. Right.
You forget me, Eric.
No, I didn't. But I was just studying, like when governor to be here, and as soon as he reached here, he settled down, we could start. But do I say we need a few more minutes, or
Oh, you're waiting a few more minutes? You
well,
have
I
to wait.
waited for him to put on his jacket? Yeah, well, he right here, so I could just wait.
When, yeah, the live stream starting now? Yeah.
Right here.
Good morning, ladies and gentlemen, and welcome to the conference facilities of Central Bank of Trinidad and Tobago. There is no emergency drill planned for today. However, in case of an emergency, instructions would be issued over the public address system. We ask that you remain calm and do not
These
panic.
lights not on.
For an evacuation of the bank, you are to proceed to the lift lobby using the exit signs. Do not use the elevators. Enter the emergency stairwell using the emergency exit. Use the handrail and keep moving downwards where you would emerge onto St. Vincent Street. Give way to persons from other floors so that they can filter into the stairwell. Once outside the bank, go to the assembly point on the southwestern area of Woodford Square, where you would receive further instructions. Thank you.
Good morning, everyone, and of the financial services industry, executive members and representatives of business organizations, executive members of the Central Bank of Trinidad and Tobago Retirees Club, management and staff of the Central Bank of Trinidad and Tobago, members of the media, members of the public who will be viewing us on our live stream, ladies and gentlemen. We are really happy that you are taking the time out to attend in person or virtually to the launch of our 2018 Financial Stability Report. I would like to especially recognize the members of the head table, Governor Dr. Alvin Hilaire, Mr. Patrick Solomon, Inspector of Financial Institutions, Mrs. Michelle Francis Pantor, Deputy Inspector of Bank, Non-Banks, and Payment Systems Oversight. They have prepared some exciting, thought provoking presentations, not to mention vibrant and visually appealing. So, no sleeping, which we hope will captivate your attention. There are 4 presentations, starting with the inspector's discussion of the key financial stability indicators, followed by the deputy inspector, who will focus on de-risking. Then the governor will bring it all together with two presentations. The first on the macroeconomic context and closing off with a blueprint for continued financial stability. As done in the past, after their presentations, you'll be given an opportunity to raise your questions, which we will answer as best as possible. When you arrived, you would have received packages, which included the overview contained in the report, the visual summary of the FSR, which was actually launched last year and has continued since then, and 4 presentations for today. All of these are already on our website. They were loaded at 9:30 a.m. this morning. So you can access them on your mobiles or electronic readers if you have them. We encourage members of the public to download these publications and peruse them at your leisure. For those who are physically present in the audience, your packages also include the Wi-Fi password for easy access to the internet. Outside the question and answer forum today, as you study our material, you may have questions. We are happy to respond to you to the best of our ability. Feel free to email us at info@central-bank.org.tt or contact the bank directly at 621-2288. Your feedback on this morning's launch will also be greatly appreciated. We will continue to strengthen our communications capacity and strive for more innovative approaches that harness technology. You could look out for more from us in the near future. There is a quote that says, "The body is a unit, though it is made up of many parts. And though all its parts are many, they form one body." In like manner, the central bank consists of many departments, and today could not have been possible without the tremendous effort, dedication, and time expended by our hard-working and passionate staff, spanning various departments, starting with research, financial technology and information security, external relations, information services, financial institution supervision, as well as the support service department that worked above and beyond so that we can be comfortably seated today. We would truly like to thank everyone and let them know how much we appreciate all the hours spent on making today a success. We will now start today's presentation by an introductory video, which was actually created by our very own Javon George, who worked with our external interface project team in bringing it to life. Thereafter, the head table will start presentations, beginning with Inspector Mr. Patrick Solomon. Hope you enjoy.
Good morning, ladies and gentlemen. pension sector that collectively account for close to 80% of the total domestic financial sector assets. Within the financial ecosystem, the central bank directly supervise and regulate 80% of the sector. As shown on the chart, we currently supervise 8 banks, 16 NFIs, 31 life and general insurance companies, over 3,000 insurance intermediaries, 185 pension plans, 6 bureaux de charge. We also regulate 4 payment systems that connect these entities. Similar to a typical ecosystem, our financial ecosystem contains complex interconnections among entities in the network. We will now discuss how these main entities performed over the last year. One performance measure for us at the central bank is the key financial soundness indicators. From the data, the financial sector has remained resilient and robust. There were improvements in the various financial soundness indicators demonstrating the strong and consistent performance of our regulated financial institutions. We will discuss these in a bit more detail in the next few slides. So we look at the key financial soundness indicators. At the end of December 2018, the banking sector assets amounted to 151 billion, funded by deposits of around 110 billion. The asset composition of the banking sector over the last few years have remained fairly consistent, with loans and investments accounting for 49% and 24% of the total banking sector assets. In 2018, the banking sector continued to maintain high capital buffers under Basel I and a robust credit quality of the loan portfolio. We are moving towards the full adoption of a more robust international capital standard under Basel II and Basel III framework. Liquid funds also remained at a healthy level, with the ratio of liquid assets to total assets at 19% at the end of 2018. The banking sector has also been able to sustain robust profitability levels through core business operations. Now we move on to the insurance sector. The life insurance sector continues its favorable trends of having a strong capital base and a good asset mix. Total assets of the life insurance sector as at December 2018 totaled 26.8 billion net of CLICO and BA. If we added CLICO and BA, the amount will be 41 billion. The preference of investments in debt securities by local insurers have been fairly high, about 50% of the asset. Notably, 80% of these debt securities are government issued or government guaranteed. The stable returns for these investments versus equity type investments have made it more attractive to life insurers. Investment yields has also been recovering. There has been slight volatility in profit, reflective in the return on capital employed ratio, mainly due to foreign exchange fluctuations and realized and unrealized gains and losses on assets. The total assets in the non-life sector was 5.9 billion as at December 2018. Two main business lines exist, property and motor. Even though the loss ratio increased in 2017, it has recovered in 2018. This is evidence of an effective reinsurance arrangements for the companies affected by the hurricanes, which buffered the extreme loss incurred and protected the capital base for these companies. We'll look at the occupational pension plans now. As at December 2018, there were 185 active registered occupational pension plans and total membership of approximately 96,000 persons. For those plans managed by the corporate trustees, the pension plan asset mix continue to be dominated by TT government, securities, and equities. You can clearly see that most of the pension assets are associated with defined benefit plans. The funding level of these defined benefit plans continue to be challenged by low interest rates. Actuaries have been recommending various contribution rates to sponsors to increase the funding for the plans. As such, the central bank continues to actively manage trustees and plan sponsors to ensure effective and timely implementation of the actuaries' recommendations. The data trends in the payment system. The volume of electronic payments have been trending upwards in general over the last several years. In value terms, while most of the electronic payment instruments have been reflecting an increase in the value of payments, the RTGS has shown a decline over the last 3 years. In terms of checks, both the volume and value of payments made by checks have been declining as reflected in chart 1 and 2. We now move to the developments in the payment space. The central bank has been monitoring closely the developments in the payment space on a continuous basis. Accordingly, and mindful of the need to strike the right balance between financial innovation and financial stability, we issued a high-level policy statement on fintech and virtual currency in November 2018, and we are collaborating with other regulators to build the detailed regulatory framework. In December 2018, we issued an e-money policy which is designed to allow certain categories of persons other than licensed bank and non-banks to issue e-money. This has contributed to a significant increase in the number of persons approaching the bank and expressing interest to engage in fintech activities such as digital wallets and other novel payment solutions. In addition, the central bank has been applying best practice international standards to assess the soundness of the country's wholesale and retail payment systems, inclusive of our check clearing and our links network, and actions are being taken to strengthen these systems as appropriate where gaps have been identified. Now we will discuss the key global financial stability developments and concerns, as well as some major risks highlighted in the selected stability report. As you could see from the chart, this is a compilation of the reports of various jurisdictions on the financial stability issues that they see. So we had a snapshot from the US, UK, Europe, Canada, Asia, Latin America, Australia, and Africa. And then we pulled it together as the common risk factors in the middle. So that will show you out of the different stability risk issues, those are the ones that are the most common in the world today. Global financial conditions tightened in the latter part of 2018 as the world economy lost some momentum in growth. In the advanced economies, financial stability concerns range from traditional to non-traditional, from house prices and high household indebtedness to trade tensions and political uncertainty. Other economies have faced financial setbacks with devastating natural disasters during 2018. Overall, some common risks facing us globally and right here in the region include tightened financial conditions, the growth of fintech and the increase in incidents in cyber attacks, growing debt, both household and public sector, and climate change and the increase in environmental disasters. We will now turn to an analysis of our domestic financial sector and the vulnerabilities and risks being faced. The summary indicates the key vulnerabilities and associated risk being faced by our financial system, along with an overall risk assessment. In 2008, while most of the financial sector vulnerabilities identified in 2017 remain relevant, two additional vulnerabilities have emerged. These new vulnerabilities are keeping pace with evolving international standards, which Michelle Francis Panto, our Deputy Inspector, will speak to in the next presentation. And the other vulnerability is the rapid digitization of the financial services industry. My focus for the rest of my presentation will be on this vulnerability, the rapid digitization in the financial services industry with its associated risk, the loss of confidence in the digital transformation. So more or less the analysis will continue speaking about vulnerability. So I want to give you an idea of what the vulnerability is. A vulnerability is any factor or weakness in the financial institutions, market, or infrastructure that increase susceptibility to the buildup of financial imbalances. A trigger is a systemic shock that results in a significant materialization of the imbalance or the disruption of the financial service. The channel is what propagates through the financial and real sector via what we call interconnectedness. And the risk assessment is you dimension the risk, you look at probability and the impact of the risk. So I'll be discussing vulnerability 4. The other vulnerabilities you would find in the financial stability report, which are detailed and analyzed for you. What is digitization in the financial services industry? It refers to the use of available technology by institutions to enhance the provision of products and services in an online or non-physical space. So you're moving away from the traditional brick and mortar into cyber space. Technology is crucial for financial innovation. Digitization, for the most part, has been globally seen as a positive development as it lowers transaction costs, reduces processing time, promotes financial inclusion, and in general creates efficiency gain for both financial institutions and their customers. In Trinidad and Tobago, it is no different. The increased rate of digitization has been made possible by an overall increase in access to technology. Participants in the digital space can be seen by the high internet subscription rates for households around 80%, and the increase in mobile internet penetration rates over the last 6 years. Over the past years, we have also seen an increase in expenditure of the financial institutions in software development. Due to this new wave of digital opportunities, we now have online banking, mobile banking, contactless payments, and other mobile applications that have certainly made our lives easier. Although digitization brings many benefits, it can introduce potential threats. And then there is cyber attacks. Cyber risks are borderless. Cyber risks are growing in scale, scope, and sophistication. The World Economic Forum in 2019 Global Risk Report ranked cyber attacks in the top 5 risk categories due to the increasing incorporation of digital technologies throughout the world. Cyber attacks aim to disrupt financial services, impeding the financial system's ability to settle transactions, temporarily reduce the funding available to institutions. They can lead to financial loss through theft and fraud and create reputational damage. Depending on the scale of the event, these cyber attacks can be channeled through the payment system to third-party financial institutions. amplifying the impact of the initial event. Therefore, what can result in a loss of confidence by customers in the safety and the security of the digital service. This can stymie the growth opportunity for both the financial sector and the wider economy. Locally, there has been an increase in reports related to digital crimes, for example, skimming. Some cyber fraudsters are abandoning the normal approach to attack outside of business hours for large sums of money to now blending into the legitimate traffic by doing it during the day for smaller quantities of cash. And these findings were from research conducted by SWIFT, and which they broadcast the world. While we embrace the age of digitization, we need to embrace it with a plan. There must be robust cyber security. And cyber security is defined as the process of protecting information by preventing, detecting, and responding to attacks. The central bank has been working with the financial institutions and other regulators to ensure that security measures are in place to protect the image and resilience of the institution in the face of potential attacks. The systems installed should ensure confidentiality, integrity, and be able to absorb the cyber shock and recover in the shortest possible time. We need to ensure that we are securing our periphery, thus protecting our core of vital data and systems. At present, the probability of this vulnerability manifesting is moderate, given the strong presence of mitigating controls adopted by our financial institutions. The impact is also considered to be moderate, so that the overall risk assessment is moderate. As work continues in this area in gathering more data and enhancing the existing systems in our financial ecosystem, we need to ensure that the institutions have an appropriate crisis management response to cyber attacks, and if not managed appropriately, the risk of spillover through financial contagion will be high. I conclude by reinforcing some of the key messages that I said throughout this presentation. The financial system is healthy. How you judge that? You look at your robust capital position, which is the buffer to absorb losses. You look at your strong asset quality, which gives you comfortable profitability levels, favorable profits, and a strong capital. So that is the interconnectedness that we tend to see there. We have growing household indebtedness as well as high sovereign concentration are being closely monitored. We have two vulnerabilities which emerged in 2018, which could threaten financial stability in the event of shocks. Keeping pace with evolving international standards on money laundering, terrorist financing, and tax transparency, and the rapid digitization in the financial services industry. So how are we responding at the central bank? We have a strategic plan, and we have strategies, we have developments and operational initiatives ongoing at the central bank to ensure that we adapt to the evolving financial ecosystem. As history has shown, that risk events can manifest suddenly and without warning. Thank you for your undivided attention. I will now introduce our Deputy Inspector, Ms. Michelle Francis Pantour, to do her presentation.
Hi. Thank you, Patrick. Good morning, ladies and gentlemen. My presentation today is on de-risking or the withdrawal of correspondent banking relationships. In recent times, you would have heard Trinidad and Tobago being named on a number of international lists due to non-compliance with global standards for AML-CFT or tax transparency. As a consequence, and due to the potential impact De-risking by correspondent banks has been named as an emerging risk in the Financial Stability Report, as you would have just heard. Correspondent banking relationships are critical for access to the global payments and financial system, and are therefore important for a country's economic and financial stability. For several years now, there have been indications that certain international banks are terminating or severely limiting their relationships with smaller banks in jurisdictions around the world. A 2015 World Bank report found that the Latin American and Caribbean regions were most severely affected by a decline in correspondent banking relationships. In addition, a June 2017 paper by Ian D'Souza on correspondent banking and de-risking in the Caribbean noted that 55% of the Caribbean Association of Banks' 41 members had experienced either complete or partial de-risking, and 8 of its member banks had no direct correspondent banking arrangements. The decline in correspondent banking relationships can be attributed to a number of factors, such as economic and trade sanctions, unsatisfactory implementation of global standards for AML-CFT or tax transparency, which may lead to excessive penalties being imposed on international banks for non-compliance with these global standards. Example, BNP Paribas was fined US $8.9 billion, HSBC US $1.3 billion, Credit Suisse $536 million, and Standard Chartered $227 million for non-compliance with requirements. Such hefty fines trigger profitability versus increased cost of compliance concerns at the international correspondent banks, as more resources in terms of technology or human resources are needed to achieve compliance. From their viewpoint, the small size of the Caribbean economies is considered insufficient to justify the increased cost. It should be noted that insufficient compliance with global standards may lead to a country being named on international list and being perceived as a higher risk jurisdiction and therefore subject to greater scrutiny and enhanced due diligence measures. Trinidad and Tobago's mutual evaluation report was published in June 2016, and in November of 2017, Trinidad and Tobago was listed on the Financial Action Task Force International Cooperation Review Group list due to its AML-CFT deficiencies. This list identifies jurisdictions that have strategic AML deficiencies, but which have agreed an action plan with the FATF and provided a written, high-level political commitment to address the identified deficiencies. The named strategic deficiencies pertain to adopting and implementing the remaining measures for further enhance international cooperation, 2, addressing issues related to transparency and beneficial ownership, 3, completing the legislative efforts to enhance the processing of money laundering charges before the courts, and 4, implementing measures to monitor non-profit organizations on the basis of risk. To date, the country has made substantial efforts to address these deficiencies, and I will speak to these shortly. In addition to the FATF ICRG list, Trinidad and Tobago is the only non-compliant country on the Global Forum's list. The Global Forum is the body established for the implementation of international standards for tax transparency and for sharing of information on tax. At the time, it was determined that Trinidad and Tobago did not make sufficient progress with respect to 1, the availability of ownership and identity information on external companies doing business in the country, and the maintenance of identity information on trust, and 2, towards implementing the critical elements needed for effective exchange of tax information. Further, in February of 2019, Trinidad and Tobago, along with several other countries, including some U.S. territories, were named on the European Commission's list of third countries with strategic AML-CFT deficiencies. The countries on the EU list were assessed by the Commission as satisfying at least one of the following criteria. They have systemic impact on the integrity of the EU system. They are reviewed by the International Monetary Fund as international offshore financial centers, or they have economic relevance and strong economic ties with the EU. For each country, the Commission assessed the level of existing threat, the legal framework and controls put in place to prevent money laundering and terrorism financing, and their effective implementation. The Commission also took note of the work of the Financial Action Task Force. It should be noted that the EU list has come in for strong criticism in many quarters, including the EU Council that has refused to ratify the list, and the FATF, who is the international standard setter for AML-CFT. So why should we care about being named on these lists? And the answer is simple, in that it can impact our country, our economy and financial system in a significant way, and make doing business difficult for the ordinary citizen. For instance, it increases the cost of doing business in terms of transaction fees or processing times, as in the case of wires. Restrictions may be imposed on the types of transactions that the correspondent banks are willing to process. There may be a reduction in the presence of international banks in the region through closure of branches or subsidiaries. As a consequence, persons may choose to use unregulated payment options, which may trigger loss of confidence in the financial sector due to the emergence of a shadow economy. Fortunately, and compared to other Caribbean territories, Trinidad and Tobago has not been significantly affected to date. A 2016 IMF survey has indicated that only 1 of 6 respondent banks has lost a correspondent banking relationship. Some banks reported an increase in correspondent banking fees ranging between 20 and 45%. Wires, check clearings, and bank drafts were the transactions most impacted in terms of increased cost or processing times. And banks de-risked certain of their high-risk customers, particularly in the gambling and money remittance sectors, to ease the concerns of their correspondent banks. More recently, since being named on the FATF and the EU list, local banks have reported that certain jurisdictions have rejected their wire transfers, processing fees have increased, and correspondent banks have applied added due diligence information for transactions, and correspondent banks are applying increased scrutiny of the bank's compliance framework in terms of compliance questionnaires, on-site visits and calls, inquiries about policies, controls, organizational structure, and resources. The central bank has not been immune to this scrutiny and has seen a ramping up of the information being requested by our correspondent banks. In fact, the central bank, as part of its strategic plan, has strengthened its governance arrangements by implementing a risk-based AML-CFT policy for the bank, although not required to do so by law. So what are we doing to address these issues? Trinidad and Tobago has not been complacent and has been taking the necessary steps to have the country removed from these lists. Such actions include the enactment of various legislative and judicial reforms. For example, criminal justice reforms have been enacted to speed up the consideration of money laundering cases before the courts. The Anti-Terrorism Act has been amended to ensure that targeted financial sanctions are implemented without delay. Laws to treat with transparency of tax issues have been enacted. For example, the Tax Information Exchange Agreement Act was enacted to address FATCA, and the Income Tax Amendment Act 2018 now allows for disclosure of information pertaining to income tax. The Non-Profit Organization Act was enacted on April 11th of this year, and the Act requires all operating non-profit organizations to register with the Registrar General's Office and for the Financial Intelligence Unit to be the AML-CFT supervisor. The Companies Act was amended to ensure disclosure of information on the beneficial ownership of companies. And the Civil Asset Recovery Act expands on the basis for which confiscation orders can be made. The Caribbean Financial Action Task Force is having its plenary meeting in Port of Spain this week, and Trinidad and Tobago's update on its 26th Mutual Evaluation Report is being tabled for consideration. Given the suite of legislative reforms being made, Trinidad and Tobago will be applying for upgrades of several technical compliance recommendations. So what is the central bank doing? As a member of the National Anti-Money Laundering Committee and one of 3 designated supervisory authorities for AML-CFT, the central bank has been doing its part to ensure that the country is removed from these international lists. In terms of its own regulatory remit, the central bank has deepened engagement and outreach with its licensed entities to ensure that they comply with regulatory requirements. In April 2018, we issued a revised AML guideline which provides for more risk-based and sector-specific guidance. Central Bank continues to contribute to discussions and advocates for strengthening of areas outside its direct remit. For example, we would have commented on bills pertaining to tax issues, the NPO bill, and the gambling and betting bill. The Central Bank continues to collaborate regularly with its fellow domestic regulators, the Trinidad and Tobago Securities and Exchange Commission, and the Financial Intelligence Unit to propose amendments to the legislation governing financial institutions and listed business. We also participate in regional and international discussions on de-risking. And finally, in terms of monitoring, the Caribbean Group of Banking Supervisors has commenced collecting information on correspondent banking withdrawals and will be undergoing training on an IMF toolkit for monitoring of correspondent banking relationships in the near future. In addition, we touch base regularly with the Bankers Association to obtain updates on their correspondent banking relationships. While much has been done to address our deficiencies, work remains to be done in all spheres. As a country, the appropriate authorities will continue to participate in relevant forums to influence decisions that may lead to de-risking and discuss solutions, be it through the passage of legislation or the implementation of policies, procedures, or other institutional arrangements to ensure compliance with global standards. In addition, the Central Bank intends to explore available technology solutions to determine how these can best assist with its monitoring of financial institutions' AML-CFT compliance. In addition, we have been meeting with fintechs to better understand their AML Know Your Customer solutions. In closing, we can take inspiration from the director of the IMF, Christine Lagarde, who in a recent speech quoted the great American poet Oliver Wendell Holmes Sr., who said, "To reach a port, we must sail sometimes with the wind and sometimes against it, but we must sail and not drift nor lie in anchor." The key message here is that as a central bank, we recognize the need to steer the financial sector safely through both current and emerging risks, such as those posed by de-risking. We therefore continue working with relevant stakeholders, domestically and internationally, to institute needed reforms and modernize our regulatory frameworks to ensure ongoing stability of the financial system. I thank you for your attention and now invite Governor Hilaire to the podium.
Thanks, Michelle 1, thanks, Michelle 2, and thanks, Patrick. Thanks, everyone, for being here and for listening to us online. When you look outside, it's a wonderful day in Trinidad and Tobago to be talking about financial stability. So what I will do after these beautiful presentations is not to repeat a lot of what has been said, but to put things in a context. The first thing would be on the macroeconomic environment, and then I'll talk about our blueprint for financial stability. The macroeconomic context. Of course, financial stability doesn't occur in a vacuum. It has to be grounded on the situation where we are in. And so this is why we want to look at what is happening in Trinidad and Tobago now. I won't spend too much time on this because we have our monetary policy report that will be coming out in a couple of weeks, and this will have a lot of the detail. But I'll just give a flavor of where we are, because I'm sure it is something that you are interested in and something that sets the stage for what we are about to be doing. So all I want to do is to just give 7 points on the economic situation in Trinidad and Tobago. And if you, for those of you who have it, your package with you, you could see all the 7 points in the first slide, summarized there neatly for you. The first issue is on the global economic situation. In essence, the mood has darkened somewhat. When I went to the IMF meetings recently, there was a pall that had kind of descended on the rooms. Why was this? Because previously, 6 months before, there was discussion on certain risks to the economic situation, the China-US trade tensions, volatility in the international capital markets, some things on the commodity markets, and so forth. And guess what? Some of these risks have actually materialized. So this is why the IMF has actually reduced its perspectives for global economic growth. So if you look at the projections and you just look at the lines, you would see it's going down. The projection was for 3.5. It has been reduced to 3.3. And this has actually been spread throughout the world, except for a few countries. I think it was China and maybe India. But generally, there is a slowing down of expectations for the world. A lot of this, as you would clearly be aware of, would be related to the political situation, the negotiations that are going on the trade side, and this envelops the whole world. So we have to be careful about that, because Trinidad and Tobago clearly does not operate in a vacuum. On the international stock market side, there's a lot of volatility. And if you look, even today, it's going up and down. The markets are reacting to news like you wouldn't believe. News coming from, again, coming back to the trade issues, the political issues, what is happening in the US, what is happening in Brexit, the resignation of the Prime Minister, and so forth. It's all complicated. It's all very intense. And the volatility is quite sharp, and it is something that is affecting the global financial system. And even for us here, we have a Heritage and Stabilization Fund. We have to invest our reserves. People are investing abroad and so forth. So it affects your earnings. It affects the stability of your earnings. So it is something that we need to be aware of, because that is something that would be determining how capital moves around borders. So if you look at the chart, it's quite stark how all the jagged stuff goes. On the commodity prices, we have some mixed news. For Trinidad and Tobago, we have seen prices of oil going up. What you have here is I think West Texas Intermediate. This morning I was looking at the price of Brent. It has tipped over 70. So it has been going up, which is good for us, but it has not been reaching to the levels as before. And why is this? A lot of things are going on two sides of the fence. One, you have the US sanctions, Iran, Venezuela, and so forth, that would be helping to push prices up along with OPEC action. And then on the other side, some concerns about growing supplies that would tend to bring prices down. So again, there is some volatility. There's some good news for us, of course, because of the price effect. But again, we can't think that this will last forever. So this is what I have to say on the global side. We could talk about it a little more on the question and answer if you would like to do so. Domestically, where are we? We have evidence of a moderate energy-based recovery being underway in Trinidad and Tobago. When we look at the indicators for 2018 and 2019, we have because of the well-known projects, the Juniper project on the natural gas side, and lately Angeline, again on the natural gas side, we have an important boost in natural gas production. That is in 2018 and early 2019, and this should spill over into the rest of the year. So the natural gas performance has been very good. And of course, we know that there are some issues that we'll have to deal with in 2020, where we had some some disappointing results with an infill drilling program, but for now, the 2019 results look good, so this could lead to a continuation of the energy-based recovery. Of course, we have the other side, because we all know that we are dealing with non-renewable resources, and this is where we are facing most starkly on the oil side. So oil production has been slipping because of the natural maturation of fields, and this has continued into 2018. And it has bumped up a little bit into 2019, but again, the trajectory is what you would expect for a non-renewable resource. Of course, we may try to boost this, but over time, we have to be aware that this is where the life is. And so on the right side, you would see some of the things that would be affecting the energy sector in 2019. As I said, the Angeline project, the Point-à-Pierre refinery could resume operations in December, and a methanol plant and so forth later on. So overall, we do expect for 2019 that oil production would continue to slip a bit by minus 5.6%, but gas production could be up about 6%. Now, but then what does this do to the rest of the economy? Let me move a little bit on to the non-energy sectors as well as the fiscal, because they are related. Why are they related? Because in Trinidad and Tobago, we have an economy that is really built on fiscal stimulus. Via the energy sector, what happens, how it spills over to the rest of the economy is through taxes, and then this is then spent, and this is what stimulates the economy. It's as simple as that. We are based on energy through the fiscal situation, and then this is what stimulates the economy. But looking at the non-energy indicators, we have some mixed performance and different indicators. Since I'm doing a quite short presentation, I haven't gone through all the details, but we would find that index of retail sales, it's up, it's down, and so forth. We have our non-energy indicators that are steady if you look at everything on average. The index of retail prices, our inflation numbers are very, very low. And the last number that we have for April, I think it was 1%, which is very low. In fact, the food inflation was actually slightly negative. Now, what does this come from? It comes from a combination of policy. It comes from imported inflation being low, a stable exchange rate, and perhaps some compression of demand. So all of this leads us to an inflation situation that is quite low, and it's a backdrop for what we are doing. When we look at credit numbers are, again, picking up in a not bad way, but business credit is somewhat reticent to take advantage of situations. So we have to look at that very carefully. There's more impetus on the consumer side as well as on the real estate side. But business credit is something we have to be watching at. Now, how does all this relate to the fiscal plans? Now, we do know that there has been a commitment by the government to have a fiscal consolidation effort. Clearly, we have had some issues with the terms of trade shock, meaning the energy price decline over the years that has affected the fiscal situation quite substantially. And in an effort to restrain that, the government is saying, well, let's commit a fiscal consolidation path over time. So if you look at the graph, you would see the graph looks at the fiscal deficit, and you would see it, or the fiscal balancing, and you would see it going down, meaning a larger deficit, and the plan is that it would move into surplus over time. Okay, this is all well and good, and I think this is important. Now we have some discussion of, apart from that, to have a fiscal stimulus in the short run, and in the context still of the plan for moving forward. So some of the activities would be accelerated capital spending, particularly infrastructure, roads, highways, bridges, etc., discharging arrears to commercial suppliers, liquidating the backlog of VAT, etc. So once you have greater fiscal stimulus, we should expect that this would spill over into investment directly, construction, and etc., etc. So we do expect that some stimulus would be apparent and help the non-energy sector. But things don't come at a cost. What do we have to look at? to deal with this, especially if you still have a fiscal deficit and you still have a problem with gaining revenue. You have to finance, just like anybody in a private capacity, you have to finance how you spend, especially if you are spending a bit more than you earn. So, what are the 4 basic sources of finance? First of all, you could sell certain goods that you have. You sell your clothes, your car, whatever. So, your assets. Asset sales, including payment of past support, that could be useful. And we have had some in the CLICO recovery. I'm putting that in the context of past support that has been repaid. And this has helped a lot the budget for fiscal year 2017-18 to the tune of about 4.7 billion. The good thing about this is that it is not debt creating, but the other side is that you cannot rely on this forever because it may be one-off. It may be idiosyncratic, and then you say, well, okay, what happens next year? So it's something that you have to be very careful about. And if you get deep into selling state assets, then you are moving into the area of privatization, which is a larger philosophical issue. So these are some things you have to be clearly aware of. The second source of funding would be external financing. I didn't put this here directly, but one would be grants. If you could get somebody to give you money, but some of it is available, but it's not that much. But if you have to borrow, either multilaterally or through the capital markets, then it is good. You get foreign exchange, you get to invest and so forth, but you have to repay it. So you have to be aware of that. And we have had recently some important borrowing from the Latin American Development Bank. And this has been helping on the policy-based side and also some road infrastructure and so forth. So this is useful, but we have to think we have to pay it back. Similarly, on the domestic side, if you're borrowing, I'm talking about outside of the central bank. Again, as Patrick and Michelle were intimating, you have to be aware that if you borrow a lot from the banking system, you could have a concentration of sovereign exposure. So that's something you need to be aware of. And then it could also be debt creating. The last one is central bank financing, where the government borrows from the central bank. As a central bank, we frown on this sort of financing because it is debt creating, it is money creating, and it could have inflationary consequences. Of course, governments use it in the short run, but we think it should really be a short run measure, but not a long-term. You don't rely on this for long-term dependence. And then you would see on the right some of the details of the constraints and so forth. So ultimately, you must have continued fiscal consolidation towards a balanced budget because you could finance your activities, but over time you need to get back to a balanced budget consideration. The fifth point is on the external side. While the external buffers remain substantial, they're expected to slip further in the short run as the economy continues to adjust. What does this mean? It means that we are still in an adjustment mode. The situation in the foreign exchange market is such that we have had some improvement in inflows on the energy side, but there is still a gap between what we are spending and what we are earning. I'm talking about on the forex side. So the central bank has been putting more money into the economy via its sales of foreign exchange. We've had to intervene, that's what they call it, intervene less because of the increased inflows, but we are still not in an overly comfortable position. We still have some work to do. What that means is that our reserves have clearly been declining over time. And we would see that the last number we have is about 7.3 billion, I think, as of yesterday or day before. Now, to put this in context, these are extremely comfortable levels, over 8 months of import cover by any stretch of the imagination. That is comfortable. But of course, we can't be complacent because we need to sort out our activities so that over time we have a comfortable situation in the foreign exchange market as previously. So we need to be aware of that. Another important buffer for us is our Heritage and Stabilization Fund. Why do I mention that? Because when investors or whoever is looking at your economy, they say, well, what is this economy's assets and what are its liabilities? So you look at your assets, you say, well, you have these reserves, but you also have a huge Heritage and Stabilization Fund, which is important because it is put away for future generations, but it could be called upon, let's say, over time. So we need to be aware of that. And we still have fiscal space with low debt, low external debt relatively, but we can't be complacent. Now, the international developments I mentioned before are very relevant to us when we get into the aspect of monetary policy. And those of you who were here before last year, you would see when we had the swinging pendulum and then we raised the repo rate to 5%. The situation internationally has changed in terms of monetary policy accommodation. And we find that the US in particular has changed course. Previously, everybody thought it was only going one way. Well, guess what? If you look at the line below, which is the green line, you would see the green line going up, and then towards the end of 2018 into 2019, it has flattened out so that the Fed has stopped raising interest rates. And there's actually discussion now of the Fed may actually be lowering interest rates, which had not been thought of before. Why would they do this? Because there are concerns that the tightening may be strangling economic growth, and if you look at issues related to the inversion of their yield curve, you would notice that the discussion has become even more lively. So there is a consensus that the rates would not go up for a while, and even some discussion of whether it's going down. What it means is that for our monetary policy, when we look at how we should to do our policy, we look at the external environment, we look at the internal environment, and the internal would clearly be looking at growth, at inflation, credit, and so forth, to see inflationary conditions and should it be supporting economic activity or should it be dealing with inflation. On the external side, since we have an open capital account, it looks at, to some extent, the interest differentials. So this puts less pressure on us in terms of the potential for capital outflow, and it's something we need to be aware of. Let me go quickly into two last items on the macro side. One is related to time, and one is related to space. No, we're not going to time travel here, but in a spacecraft. But time. We've been here before in terms of the economic situation. And of course, we need to learn from the past. If you look at just a quick snapshot here, the blue line looks at the growth trajectory over time, and it's quite stark. You could see when there was periods of growth, and you see periods of decline, and so forth. And then the green bars are energy prices, oil prices. So you could see a kind of rough correlation. What does it mean? In the 1970s, for those of you who have been around for a long time, I wouldn't ask for a show of hands as to, what were you doing then and how old you were then, but some of us have experienced it. And you say, wait a minute, oil prices went up, it was sudden, but guess what? People got used to it. And then they were surprised when it stopped because, you get used to a certain lifestyle and, you're shocked. And then they say, okay, well, then it came back up. Oil prices came back up. And guess what? They got back used to it. So now, one of the things with humans is that once you get used to a certain lifestyle, it's very difficult to go backwards. So adjustment is always like that, and we have to be aware of that. But we've been here before, we've done that. We had a period in the 1990s when we had to have a lot of economic restructuring. We had IMF programs, we had World Bank, structural adjustment things, we had removal of the negative list, we had floating of the currency, you name it, we had it. Debt restructuring, everything. Then oil prices went back and people forgot about that. Wait a minute, we have to learn from the past. Some of the lessons are that adjustment must be comprehensive. You must take the entire economy into account. It's not just the energy sector, it's the monetary sector, it's the diversification, all this sort of, everything you have to look at. It's everything as a whole because everything is connected. The second thing is coordination. Policy must be coordinated. Fiscal, monetary, structural policies for you to have, for things to go well. The third thing is that policy must be forward-looking. You can't be just dealing with policy now or things happening now, because things will happen in the future. You have to be aware of what's going to happen. Because if you don't save, if you don't plan, something external will happen to you again. So you have to be able to plan for that and plan to be resilient in the future. So this is just some broad lessons, but it is important for us to be aware of. So this is time. Space. Despite our small size, the economic influence of Trinidad and Tobago remains far-reaching. Well, all of you would have seen the 4x4 relay team, what they did and how we are on the world map. I mean, we little, but I wouldn't say we're small, but we talaba, because that's a Jamaican expression. But we have a lot of influence. Despite our economic problems, despite our small size, we are really a big part of the equation internationally. Let's look at migration and remittances. We looked at we had a study a couple of years ago at the Central Bank on remittances, meaning how much money comes into the economy from people who work abroad and vice versa, how much you send abroad. And the numbers were actually quite negative. In other words, that the people who came to Trinidad and Tobago and worked sent out more money than the people who came from abroad or who went abroad, trainees who went abroad, and sent money in. It means that we are a very attractive place for people to come. And if you look around you, you see a number of people from a number of different countries. Of course, now, the Venezuela situation is upon us. And it is something that we have to be very clear about and understand carefully. The studies that the research department has done has estimated that the fiscal cost could be on the order of about 620 million TT dollars per year. This is substantial. Initially, I doubted them. I said, no, this can't be. But when I looked at other countries, I looked at Colombia in particular, and they estimated that it would cost them about 0.4% of their GDP. In their case, they have got about 1.2 million Venezuelans who have come in this situation now, which works out to be about 2.5% of their population, which is close to 50 million. If we, at a lower estimate, get 40,000, from what I'm reading, I don't know myself, but this is what you hear, this works out to be about 3% of our population. So the numbers are reasonable. But it's something that we have to be aware of because the short-term and long-term impacts can be significant economically. It is a humanitarian situation, but we have to be aware of the economic impact. Now, in terms of how do you finance this, of course, it will be a hit on the budget. In some countries, they have, and it's something that we would advocate strongly, got international assistance. For example, Colombia received US $31.5 million from the World Bank fairly recently. And this is a grant, so they don't have to repay it. There has been set up in the Inter-American Development Bank a facility for about 100 million US. we should be able to access part of that because of the seriousness of our situation. So it's something we need to be aware of. In terms of the economic spillovers, which is point B, we already have significant regional financial capital flows. You all know about banks from different countries coming to Trinidad and Tobago, insurance companies in and out and so forth. So capital is mobile, capital is moving throughout, and so we need to be aware of that. And we are a big player in the Caribbean. And ultimately, a strong Trinidad and Tobago helps the rest of the region via trade because we import more from them, investment because we're able to invest in their countries, and support. In the days when we had when our oil prices were up here, well, everybody's oil price, but it was good for us, but not good for them. We provided support via debt relief, CARICOM multilateral clearing facility, etc. So that is important. Lessons from our experience. We have a lot to teach the world, believe it or not. Just in March, I went to Mozambique at the invitation of the central bank there to talk to them about our sovereign wealth fund, which is our heritage and stabilization fund. Why? Because they are on the verge of a natural gas boom, and they want to know what to do, how to save and so forth. So I was able to share our experience. Last week, Friday, a team from Guyana came to visit our central bank, and they met with the board of the HSF to talk about a similar topic. How do you do it mechanically? So we could teach the world a number of things from our experience. Energy sector management. A lot of our engineers and technicians are in Africa and Guyana explaining our circumstance, how to do things and so forth. Financial resolution strategies. And next week I'm going to Curacao to chat with them about how our experiences are. So all of this, I just give some very short examples as to how we are influencing the world, but how we are influencing the world also influences us. So try not to be mesmerized by this too much, but there's an important feedback effect. To the extent that we help some others, it helps us. And to the extent that we are in difficulty, it affects the others. And so there's an important feedback effect that we have to be aware of. So this is the first presentation now, just to give you some food for thought on the macroeconomic situation. So let me go directly into the financial stability part of it. As I said, let me reiterate about the beautiful presentations that we had from our people this morning. They gave you a lot of the details already about the issues that we have to face on the de-risking side, on the digital currency side, on et cetera, et cetera, et cetera. So what does that mean? We all have to recognize that financial stability is important. If you have a financial problem in your country, then everything could be in problems. So, as again, we have the first page that gives you the summary. You could go through it at your leisure. Let me start by just recapping very quickly some of what Patrick said. And basically that our banking system is sound, that we have high capital, healthy balance sheets, and so forth. Non-performing loans are very low. So this is the general situation. The insurance sector also has a strong capital base and is profitable. And the non-life segment has also exhibited resilience to weather-related shocks, et cetera, et cetera. So this is in a nutshell our financial system. I'm not excluding the others because they are important, the non-bank financial institutions, the unit trusts, we have the credit unions and so forth. But they all kind of fall into this category, broadly speaking. But, as I mentioned before on the slide with the macroeconomic situation, we can't be complacent. Why? Because we've been there before. We've had, again, this is kind of looks like the one we had before, but it looks like the financial issues. 1970s, we had the boom. We had financial institutions ready to take your money. Interest rates going through the roof. I mean, it was amazing. Then, of course, you have financial problems born of whatever it is, governance issues, mismanagement, but also that could be revealed when the rug is pulled because you have the economic situation turning around. Then we have financial failures in the 80s. Sorry, we had the Workers' Bank issue, National Commercial Bank, Cooperative Bank, the merger, CLICO issue, and so forth. So things could happen, but we are trying to prevent things happening in the future. But you can't be complacent because the shock that you saw before, if you prepare for it, guess there's another shock, waiting for you. So, as was mentioned before quite clearly, in today's world, vulnerabilities and risks abound. I won't get into this, but you could look at it and you'll see they had been all laid out to you by the team, including the correspondent banking, cyber, natural disaster, and all because we have a more interconnected world and larger institutions, So, let's go into our blueprint for financial stability. Why do we call it a blueprint? Well, for those of you who did engineering or drafting or whatever, or build a house, the blueprint would be what you put together as the series of plans to guide you. So our series of plans would be incorporating 4 elements. One, what we call the site plan, how we allocate it internationally. The second, which is the more exciting one, which is the architectural drawings where you see all the, the elevations and the floor plans and things. How we establish our priorities. The third thing would be the engineering part of it, which is the people aspect, which is quite important. And the fourth thing would be on the utilities, the water, the sewage, the plumbing, the electricity, and so forth, which is how we interact with the rest of the community. So I'll briefly go through this for you so you could just see some of our priorities. So the first one is on the site plan. How we collaborate internationally. I just want to make two major points on this, or 3, let's say. Technical assistance, we've received excellent technical support from a number of international agencies, including SEMLA, CARTAC, European Central Bank, etc., etc. And you could read about it to understand what these are. Why is this important? Because we need to get to international standards. We need to understand what is best practice. We need to be tagged in to the world and what is happening. And also because a lot of this experience could help us because other countries have gone through what we may be going through or what we have gone through or what we will be going through. And you could see the type of technical assistance we receive from the IMF and CARTAC in a number of areas over the years. One thing I want to emphasize is that at the end of June, we'll be having the first of a series of 3 missions from the IMF and World Bank on a financial sector assessment program. This is a comprehensive and in-depth assessment of a country's financial sector. And high-powered teams, I met them in Washington recently. They've really got the best of the best to come to Trinidad to examine our financial system and to report to us and to give their recommendations and so forth. It will be conducted in 3 missions, one in June, one in October, and one in probably January next year. I've already discussed this with BAT, or Bankers Association. Next couple of weeks, we'll discuss it with ATIC. But This is quite a crucial engagement because it will give us some perspective. And we are really looking forward to it. It is not an abstract exercise for us, so just a report. Do we get A, B, C? No. We are using it to guide our own staff, to guide our resources, and to understand from a technical and objective point of view how we are doing. We had an FSAP, what you call it, in 2005, and one in 2010, which was a limited scope, but this one would be focusing on important areas for our situation. Just recently, we were invited to join the Financial Stability Board. The Financial Stability Board is a grouping that was built up of the large economies, financial sector agencies, right after the global financial crisis, because there was deep concern that people didn't anticipate the global economic crisis throughout the world, and they didn't anticipate how deep and pervasive the repercussions would be. So this shock kind of galvanized international action into this area. So out of that, you have a number of standards that have been emerging that have helped. In Basel, you have a lot of things on different areas. So the regional, you have different groups for different regions of the world. You have one for the Americas and including the Caribbean. So we were invited. We happily took up the offer, and I went to Argentina recently to discuss things with them, and they discussed a number of recent initiatives. I made a presentation on small and medium-sized enterprises, how they report on this. So it is quite interesting because we have an opportunity now to be part of a grouping that develops international standards, as well as to see how we are responding to them. The second part now is this, as I said, the elevation. So let's look at, well, the architectural drawings. This is establishing our priorities. All I want to say here is that in our strategic plan, as mentioned before, all of the priorities are well laid out. The strategic plan is a 5-year strategic plan. We just finished half of it. You are welcome to look on our website. You will see the plan. You will see how we do. So we did our mid-year review. It finished on the end of March. So by the 1st of April, we had our review of what we did. So you're invited to look at it and comment. We have 3 basic themes, which should be monetary policy, financial stability, and internal operations. So this is on the financial stability side. So you will see all of these things here, and a lot of this was pointed out that you could look at. I just want to focus on a couple of things. One is that one key immediate priority is finalizing the CLICO BAT resolution. As many of you would know, over the 10-year period since the CLICO BAT intervention, it's already 10 years, imagine that. So the central bank took emergency control under a certain part of the act, and there's a resolution plan that was developed. What was important about this? Well, the first thing is to stabilize the situation because of the gravity of what happened. Devoting ourselves to establishing overall financial stability, which is the raison d'etre of our being here today. Of course, the government had paid for part of the resolution, so part of our mandate was to help to reestablish that creditor, not wholeness, but repaying the government and its credit. And of course, ensuring the policy holders of these agencies are well protected. The bank is highly accountable for this, so we report to the court and the parliament every quarter. So we've had 30 reports so far. The last one was the 31st of March, 2019. The next one is the 30th of June. One important component of this is the sale of the traditional portfolio. There are currently over 98,000 active traditional portfolio policyholders for CLICO. And then if you add BAT, there's another 30,000 or so. So it's a lot of people. When we complete the sale now, this would be making sure that these policyholders policies are in safe hands. So this is where we are moving towards. And this, in terms of the process, just to reiterate, we adopted, along with CLICO and BAT, a rigorous, transparent bidding mechanism to international standards. We have dedicated in-house actuaries, lawyers, accountants, etc., some of whom are watching me right now. But of course, you have to have international, external counsel, independent international evaluator, and a specialist financial firm to handle the bidding process. It took 3 rounds, several years, and a preferred bidder was identified, and a safe sale and purchase agreement is to be signed. At present, the Ministry of Finance is consulting with the central bank on a portfolio sale consistent with existing legislation. So this is a priority that we are moving 100% towards fulfilling because it's part of the financial stability mandate. The legislative and supervisory frameworks for insurance companies, credit unions, the payment system need to be fleshed out. All I would say is that we have had excellent momentum built last year with the Parliament getting together to approve the moving forward the insurance legislation. We have some tidying up to do, so we are working very closely with the Chief Parliamentary Council, with the Ministry of Finance, with ATIC, with the industry and so forth to move this ahead. A couple things that need to be done, guidelines, regulations, and the taxation thing. But we are pushing, and we are hoping that this is fleshed out very, very quickly. Then we have the anti-money laundering issue, which Michelle had talked about. And then other reforms governing pensions, credit unions, the payment system are being considered, as well as the issue that Patrick talked about, virtual currencies, crypto assets, etc. So let's go into in the last few minutes, the people factor. People are part of the equation. People are the source of sometimes the source of the problem too, but the source of the solution. And you have to have good people. I am blessed to have a wonderful staff, 565 of them, rooting for everything, but not everybody is as fortunate. And I'm trying not for them to go away. So the people factor. Recruiting and training high-quality staff is critical to successful plan execution. Sometimes it's not taken that well into account, but if you don't attract the right people, if you don't keep them motivated, if you don't train them successfully, then you cannot have financial stability, supervision, and regulation that is high quality. So in that, we've been receiving continuous local and international training because it's important to keep abreast of things. So that's a high priority for us. But they must be also supported by practitioners in other fields, including actuaries. So these are the people who are working in our supervision department under Patrick and Michelle and so forth, Michelle 1 and Michelle 2. But they have to be supported by the economists, actuaries, lawyers, accountants, communication specialists, IT, and people and so forth. Right? Oh, by the way, when they did this graphic, they said it was at the top. They said it was like it's too many men. The women were complaining, but somebody else said, well, maybe it was the men just walking around talking, and the women in the back doing all the work at the desk. So I don't know about that, but we have a good mix. But the training is critical for us, and we spend a lot of time not only through courses, but attachments to the Bank of Canada, to wherever, because we take it very seriously. And so on a regular day, you see many departments work in sync on financial stability issues. It's not a one-man show. We have, as was said, even for this presentation today, a lot of our staff involved in different departments, and everyone, as a central banker, is not just located in one area and just doing their thing. They are part of the financial stability mandate. So we are very proud of that, and we work closely on this. The last thing I would talk about is on the what you call the utility side, meaning how do we cooperate with other financial actors. We have some of them here today. We have our DIC and so forth. But before I get into that, the financial institutions, although we supervise, we rely on the financial institutions to be part of the solution, to keeping things stable. They have to do this by keeping good governance, good accounting, do the right thing, and we interact very closely. We have quarterly meetings with the Bankers Association, semi-annual with ATIC. We meet with all the rest of the sector, of the financial sector on a regular basis and have continuous interaction. So to us, it's quite important. We have some guidelines that we put out, but it's also important for those guidelines to be supported by self-grown codes of conduct. So we encourage that, not just for putting them out there, but for adhering to them. Self-regulation is important because it is critical for people to be able to have confidence that the financial institutions will be treating them fairly and their activities would be safe, secure, and to their best interest. So we look forward to the participation of the financial institutions themselves in promoting financial stability. And as I said, we have our interaction. We have the Deposit Insurance Corporation, Securities and Exchange Commission, Financial Intelligence Unit, on the credit union side, Commission of Cooperatives, and so forth, external regulators, everything. So it's not a one-man show. We are part, as regulator, part of a larger scheme. Codependence, we had talked about that before, where because of all these interactions with financial institutions from one country and the next, we were talking to a couple of board members of a large financial institution, and he said, you know, we are relying on you guys to really improve your supervision because of the interaction with other Caribbean countries, because with Jamaica, with the Eastern Caribbean, with Guyana, with Turks and Caicos, the Bahamas, Bermuda, everybody is codependent. We have, so, I mean, the colleges that we have to go to, colleges mean not like St. Mary's and so forth, but you have a college when you have like a big institution and you have a meeting from the different jurisdictions to discuss a regional institution. That's the kind of college. They're growing up more and more because they're so important. Everybody has to rely on everybody else. So in the central bank area, in the insurance area, in the financial action task force, the group of banking supervisors, etc. So all in all, putting all elements in action to keep things safe, this is where we are at the central bank, part of the solution, and we look forward to your assistance. We're working with skilled staff, trying to modernize legislation, keeping extensive collaboration, looking risk-based supervision, and above all, constant vigilance. So thank you very much, and we look forward to your questions.
Thank you, Governor and inspectors, for those exhilarating and informative presentations. As a central bank, we value interacting with our stakeholders. So as such, we will now take some questions from the audience. I just want to remind you of the ground rules. You walk to the microphone and state your name and your organization, and then begin to, ask us questions. Don't all rush.
Good morning. Hopefully I inspire some people to follow. Governor, first of all, the Petrogen situation. Okay, give me 1 minute. The restructuring situation, is it that it's too early? You didn't really mention it. Is it that it's too early to really assess the impact of the restructuring on the economy?
Yes, thanks. We think this could be a quite important thing. As we understand it, clearly it is getting out of the refining business and trying to organize things in a certain way. We do believe clearly that there will be some short-term adjustment costs, but if handled well, we think it could be beneficial over time. But it is important for it to be handled very, very well so that we could get the benefit out of the restructuring.
But have you done any assessment on the impact yet to the overall economy?
Well, what we've found is that clearly refining activity has declined in the short run. But we are still waiting because it's early days yet. We know that we have some payments that need to be handled. We understand that is going on. But we think it would take some time for us to see the net impact. But we do believe that to the extent that you have efficiency gains, then it could be beneficial over time.
And the Clico bat sale, can you tell me who you've decided on as a buyer for the portfolio and the value? I mean, it has been known. I just need you to tell me officially.
Well, those are confidential matters. We are bound by two laws. First of all, the central bank law on confidentiality, and second, contract law. Because, as I said, the process is still underway. It has gone to a quite advanced stage, but I cannot comment on that because contract law and central bank law would prohibit that.
Okay. I'll ask the Minister of Finance. And just, well, they recently had the Atlantic announcement and, well, the BP disappointing results. I'm assuming as well that it's too early for you to make any assessment on that, but would you like to comment on it? Because you did say that, you expect natural gas to be maintained at 3.8 billion cubic feet.
Well, our understanding, and I mean it seems to be quite open, is that would have a negative impact in 2020. So you may not have it in 2019, but in 2020. So that is not good news by itself. But I think the important lesson is that we have to be focused on things that we can control as an economy and as policymakers and so. You could find that suddenly you have a huge oil find somewhere, or suddenly something that you thought was going to be large ends up being small. So some of those things you cannot control. I think by itself it should have some negative impact in 2020, but it is possible to probably do things that would compensate for that are under our control. But what is in the ground, you don't know until you go.
And this evaluation with the IMF and World Bank, that's not the Article 4. That's not. Do you know if we're going to have an Article 4 consultation?
Let me just explain the Article 4 consultation. For those of you who may not be aware of it, as a member of the International Monetary Fund, all countries agree that under the Articles of Agreement, Article 4 of the agreement, you would invite a team and they would discuss economic policy and so forth. This would be reported to the board. We are on I believe, a 1-year cycle or 1.5-year cycle. I can't remember. The last one was 2018, I believe. So yes, I don't know exactly when it would be, but it should be something. But the financial sector assessment program is separate from that completely.
All right, great. And remittances. Now you said more money goes out than comes in. Is that a strain on our forex?
Well, I mean, if you look at it directly, the net flows of foreign exchange for remittances would be negative. But of course, you have to look at it in another aspect, because what is the benefit of, you may have benefits on both sides, in the sense that, let's say you have a trainee going to work wherever. He or she may send some money home, but he also develops capacity to educate his children, and he may come back afterwards and contribute to the country and so forth. So the benefit of a Trinidadian going abroad may not be measured only by the remittances. Similarly, if someone comes here from whatever country, the benefit that they may send out some money, but they also contribute to building the country. So yes, if you look just at the flows and the balance of payments, and you see inflows minus outflows, that would be negative for remittances. But in terms of overall contribution, it would not be that, you can't just measure it like that.
All right, great. And well, my final question is Venezuela.
Yes.
How much has that the migration situation been factored in your financial stability report? And especially considering, the value of immigration, what is the bank's outlook on the current situation?
Yeah, well, in terms of the actual financial stability report, it is still early because the situation, the registration is just going to start and so forth. But we try to look at everything very clearly and precisely and in a forward-looking manner. So that is why we are examining the Venezuela situation as we do. As I said, I was surprised at the early assessment of the 600 and something million, but when I look at it, it is quite important. In the short run, what are the costs? Clearly, you would have, or what sectors would be affected on the economic side? The labor market, surely, the housing market, social services, and then you have a number of other things, the national insurance, your health, your security, and health, security, a lot of things. So we know that it will be important. As I said, in the case of Colombia, it was quite stark how much the impact was. So we do believe it could be very significant. It needs to be handled well, but it is important to address it very clearly and to look and not be surprised.
Well, since you've done a cost analysis, did you
Yes.
do like a benefit analysis? What could be the benefits to the economy from migration?
Or the economic benefits could be as a result of anything where humans move and they bring something with them. What do they bring? They bring their skills, they bring their approach to things, they could affect the labor market and so forth. So there could be potentially very large benefits over time. Taxation, they would contribute to taxes and so forth, but not in the immediate run. But again, this would have to be balanced by the other considerations. But it's just like any other migration. When you see throughout the world, when people go from one country to the next, they bring something to the table. So we think that over time you could have some benefits, but in the short run, we think it could be something that you have to deal with on the fiscal side.
What specifically has the bank been looking at in terms of the Venezuelan migration? Is there any sort of impact per se that you all are looking at besides the cost?
Yeah, well, as I said, we look at everything. We have a research department that is very keen to look at everything under the sun. So we examine how things are evolving. So we track very carefully the political situation, the security situation, we track the probabilities, and we may not always be right, but we look at it. We look at the reaction of the international community. We have people at the IMF, World Bank, IDB. We look at what is happening with the flow of funds or the funds available. As I said, we should be able to tap into the IDB and the World Bank for support. And in those forums, you have a lot of lively discussion on the Venezuela situation. So we are able to get to understand that. So we do track it very, very carefully. We look at all dimensions that we can, but some of the things are still not known. I mean, we don't even know the registration process, but we think it is important because of if you're talking about 3% of your population, it is not something to ignore.
Well, you said you advocate strongly for international funding. How, influential are you in, influencing that decision in, accessing that funding?
Me?
Yeah. The bank, you.
Well, we'll push to our utmost. I think, as I said, Trinidad and Tobago is small, but we have a voice. We are, for example, in the group of 24, which is the developing country bloc that talks to the IMF and so forth. We are like the smallest member, but we have influence. So I think we just have to leverage our influence. We are a long-standing member of the IMF, of the World Bank, of the IDB. We don't actually take much loans from any of these organizations. I mean, our last fund program was in the 90s. The World Bank, we are supposed to be high income, so we're not getting much from them. The IDB, we get something, but it's not. So we have influence. We just have to coordinate and to use it.
And well, finally, I have
Please.
to ask you this question. So recently in Parliament, a couple of weeks ago, there was some conjecture that the central bank was unduly influenced by the government, specifically the Ministry of Finance. How would you respond to those sorts of allegations in terms of the independence of the bank?
You had what? I just thought that there was. Go ahead.
How would you respond to allegations that about the independence of the bank, as raised in Parliament a few weeks ago?
I can't remember what was in Parliament exactly, but let me put it in a couple of dimensions. The first is that we do respect people's perspectives on our work, but to the extent that it is their perspective and they feel to share it, then we would welcome their sharing it. If there are specific comments on our analysis, on how we did certain things, on the data and so forth, we address those very directly. And in fact, a lot of the journalists always send us questions, how did you do this, how did you do that? So we respond very directly. But, people are free to have their perspective. We respect that. And we listen to everything and see what we could learn from it.
All right, great. Thank you, Governor.
You're welcome. Now, you have other people here you could ask to. Don't be shy.
Hi, good day. Michelle Jadu, representing First Line Securities. Just want to comment and ask a question about, in your slide, you mentioned about coming soon pension adjustments or looking at pension plans, right? One of your last slides. And in one of the previous presentation, there was occupational pension plans. Under the government side, we have 35 plans of comprising $29.9 billion in assets. Is the central bank advising the government to probably move away from defined benefit plans because of the potential burden it could lead to future generations, given the low interest rate environment, the potential that the recipients of those plans down the road, the plans may fail? I mean, that could be a tremendous cost to the central bank and to the generations that have to bear it. And this is not taken into consideration the NIB, what's going on with the NIB, clearly, because this is 29.9, NIB is 24 point something.
Yeah.
So we have a real problem here. Anybody address this in terms of research, the potential impact, when it will start to impact the economy, things like that?
Okay. What I can say to you is that the government is aware of the issues and they would make the appropriate action. Like, for example, you mentioned the fact of your defined benefits, but the alternative is a defined contribution. But if you move from the defined benefit to defined contribution, you still need to fund the defined contributions because you would have certain predetermined obligations that will not go away. What people tend to do is to look at the existing system and come up with a variety. But based on our analysis, although there's a lot of talk about defined benefit and defined contribution, we are not seeing a lot of activity of people moving from defined benefit to defined contributions. So there's a issue that is generic. What we tend to look at is that the risk associated, and you mentioned the fact that there is funding risk and there is solvency risk, but there are different ways that you can fund a pension plan in deficit. So the government is aware and they would make the appropriate decisions. So this is the purpose of the Financial Stability Report, is to highlight what we consider to be vulnerabilities, but you have to have certain triggers which will turn the weakness into a risk or loss, and that hasn't happened yet. So you're looking at the actuaries who are evaluating the plan, and as we said in the report, the central bank is speaking with the sponsors, which will definitely be government as one of the areas, and to make sure that they comply with what are the recommendations of the actuaries.
Okay. But there seems to be some movement because with regards to the government side, is almost 100% defined benefit. Like, is 0.32 billion assets in defined contribution or hybrid, whereas in the private sector, it's like 2/3, 1/3 split. So there seems to be a move in the private sector where individuals have some equity in their retirement. I think the move should be with regards to the government as well, because as individuals, we should have an equity stake in our retirement. Our employers shouldn't have the primary stake. I'm talking about trying to change a mindset as well, because people, the immediate beneficiaries next 5 to 10 years will be funded by this.
Right.
This will have assets to fund them. But in a low rate environment as projected to last maybe 10, 15 years from now, because if it does flip and rates go high, you're going to have asset prices going down, so you have a comparable loss.
Right.
You know, you're going to gain on earnings, but you're going to lose on asset prices. So it's not reality to expect that rates are going to go up and these plans will earn money to go, to be able to fund into perpetuity. What I'm looking at, what I'm saying is, not just from the point of view of the survivorship of the plan, but in terms of having the contributors of the plan understand their equity stake in it. Because a lot of them think that they're going to get this retirement fund. They depend on it. When they understand that they have a defined contribution plan where the benefit varies, they may say, maybe I should have a secondary plan, a private plan, to supplement my government plan. And if triggers aren't pulled and people aren't informed that they need to do this, they may not do it.
Okay, like what I could respond to that and say that the government looks at the pension in totality, because this is simply occupational pension. You have the NIB and other things. So you have to look at it from a holistic point of view. You are looking at it from this solo viewpoint. And I think the government is aware of the issues, and they are looking at it as a collective decision.
Okay. Thank you.
Good morning, Janine Brown, TTT News. Governor, I want to go back to something you said at the Stability Report last year regarding the parallel black market. And at that time you said that it was a moderate concern, but you also said it's not a healthy financial environment to maintain where supply cannot meet demand. So considering that, has the position of the bank changed in that regard?
No, we are consistent in the sense that, first of all, we do think that we are still not in a fully comfortable position. We are still in an adjustment mode, where because there is a demand that is higher than supply, then we have a loss of reserves. So this is not an overly comfortable position, but no, we are still in the same. We still have the same consistent position.
And as it relates to the black market for foreign exchange, has the concern grown at all? Or?
Well, I don't think we have ever characterized it like that. What we do know is that once you have demand more than supply, then people will try to find supply somehow. And so therefore that could push up rates somewhere else. What we have observed, and if you look even casually, that the premium or the difference, I mean, I'm not a participant and I don't think any of us are participants here, but the premium outside is not very substantial relative to what we have. But having said that, it is something that we are very conscious of. That is why I emphasized the trajectory, and I always emphasize the importance of coordinated fiscal, monetary, and structural policies.
Thank you. Perhaps, I guess, Mr. Solomon, on the issue of rapid digitalization that you mentioned, how does legislative amendment or lack of amendment impact on the customer confidence that you spoke about?
Could you repeat the question?
On the issue of rapid digitalization, how does legislative amendment or lack of legislative amendment impact how customer confidence in that regard?
Could you amplify what legislative adjustment you're speaking to or you're referring to?
I just mean if the legislative environment, if the proper legislation is being passed or being brought to the Parliament to deal with that.
Okay, what I can say is that it's very difficult to legislate for cyber attack and technology changes. We have had different consultations with international body, and the forms keep changing, so it's very difficult to identify a particular legislation that will fit all situations. What we are doing domestically is as the central bank, we are making sure that the institutions advise their customers in terms of what they are doing in terms of the impact of education and how to deal with the digitization that I'm speaking with. What we also do is more or less speak with the institutions to make sure that they have a plan to deal with the cybersecurity. So you would have to make sure that you have a business recovery plan, you have a business continuity plan, you have an information security plan. So if you had to legislate, well, you don't really legislate to the institutions. We say, look, there are certain what we call hygiene factors that you must put in place when you get into technology. And this is what we are insisting. So the legislation by itself will not improve the resilience, but what is going to improve it is the practice behind the scenes. Like, for example, it is often stated that the next global financial stability issue is going to begin with a cyber incident. So how do we respond with that is that we have to collaborate and we have to attack it globally. So you can't have legislation that is peculiar to Trinidad when the risk is global. And in my presentation, I spoke about cyber risk being borderless. And being borderless, this is what the governor was speaking about, is a lot of collaboration taking place. So in terms of one specific legislation that is peculiar to Trinidad, that wouldn't work because the cyber risk is global. I think the deputy wants to say something.
In terms of, is it on?
Yeah.
Yeah. I think you were also probably asking about fintechs in terms of the fintech legislation.
Yeah.
Well, from that perspective, there's no one piece of legislation that speaks to all fintech activity. So the central bank has some powers under its legislation in terms of oversight of payment systems and money transfer, money remittance businesses. And what happens is that a lot of the fintech activities will fall under those type of categories in the offerings. So we are currently trying to build out a more holistic framework. So we have piecemeal legislation that are not totally complete in some areas to govern all aspects of fintech operations. So based on our current, we would have issued a policy statement saying what is our position with respect to fintech. And in terms of onboarding some of these entities, we are also learning areas where we need to close gaps. So we have initial views. So we would have issued an e-money policy where we are saying that we want certain arrangements, certain things covered in terms of thresholds, governance, consumer protection. So that e-money policy is dealing with that, and it has to be made by ministerial order, which we are currently finalizing the policy to be submitted to the Minister for making of the order. But there will be a need for more going forward, a more holistic act, probably payment system or fintech act, like we are seeing other jurisdictions develop a fintech legislation. So going forward, we will need to do that. But what we are learning now is gathering all the bits of information to give us that input into developing a more holistic legislation that will govern all the pieces and all the moving parts.
Thank you.
Good morning. Very good presentations. Noel Noons from Deposit Insurance Corporation. You made mention of the vulnerabilities, one of which was the growing household indebtedness. And when I looked at the blueprint and I saw the interactions with the domestic players, I seem to be missing the group called the general public. I appreciate the intervention on the aspect of governance, because one of the major things that contribute to institutions' failure is poor governance. And you made mention of it in terms of how you're going to embrace and take that on from the Basel II and Basel III aspects of things. So I appreciate that. So my question is, what part are we going to tackle with respect to the treating with the growing household indebtedness if we don't bring the general public in terms of the financial literacy and so on, other aspects of it, to ensure that we strengthen the public side of things to help in the overall aspect, not just the institutional, but the public side of things. Thanks.
Yeah, let me just, since it's a general issue, and then Patrick could weigh in if you want. All right, the issue of household debt, I mean, the public is part of that because they are the households. And why is it important? Because if as anyone in your own particular circumstance spend more than they earn, then they're financing it somehow. As I mentioned when I had the four points, you will be getting more and more into debt. Now, in Trinidad and Tobago, we have a kind of self-regulatory mechanism in the sense that the bank's not giving you credit past a certain point. In the US, it's very different. So if you look at what is happening with education debt in the US, is massive. Children go to school and they come out from college, which is university equivalent to what we call college here, and they're heavily in debt because debt is so easy to acquire. Credit card that you go through the roof. But it is a problem because then people overextend themselves and then they cannot finance the activity over time. So that is why it is important for us to look at household debt. And it is, the general public is part of that. So consumers are part of that. The second point you mentioned, which we relate to very substantially, is on the financial literacy. And you will see the ombudsman here somewhere in the front there. Ombudsman come financial literacy guru, because he has now the two hats. So if you see a fellow wearing two hats, that's him there. He has now the two hats because the ombudsman part of it is on the kind of mediation or resolution side of it. And the literacy part is to prevent you from getting into trouble, right? And our program has been evolving more and more into explaining about budgeting, explaining about debt, and encouraging people to be aware of the dangers of what is an account, how to get the best deal, and how not to create problems for themselves. So it is a big part of the central bank mandate. It is something that is part of the supervision, clearly. We do it on the market conduct side. We had a market conduct guideline last year to encourage, well, to kind of mandate or to make it a requirement that banks have truth in lending so that they don't encourage people to just grab credit, and before you know it, you kind of get seduced into something that is high interest, and next thing you know, they're asking for your house. So to get the banks and the financial institutions away from that, as well as to, on the other side, in collaboration with the NFLP and the Ombudsman, to build financial literacy. Just last year or the year before, we had an MOU with a number of financial institutions and agencies, including the Tobago House of Assembly, you have the Bankers Association, and so forth, to have a national financial literacy center. And that one aspect of it is on budgeting, saving, and the dangers of debt.
What I could say is that when we did the financial stability report, we looked at the composition of household debts. And based on the composition of the household debts, you'll see the largest item is usually a mortgage, followed by a motor car loan, followed by credit cards. So this is how we have been seeing the balance sheet of the individuals. So that's why we say there is a high household debt, because a lot of the items that I just quoted are necessary to function in this environment. What we have been seeing is a pattern where the households have been refinancing and consolidating the debts. While this is occurring, it means that probably they are under some sort of pressure, and probably they are listening to the advice given by the financial stability unit of the bank, and they take the opportunity to refinance. So while we speak about high household debts being a vulnerability, it has not yet translated into a risk, because the interest rates and the triggers have not progressed it from a weakness into an actual loss. But the purpose of the financial stability report is to give you an idea of what or trends that we are seeing in the market, and high household debts is indeed one of the factors. So this report is supposed to build awareness and for people to respond accordingly. Look at your portfolio and manage your balance sheet in the most appropriate manner.
Okay, so thank you very much for all your questions. And if for any reason you have any further clarifications, you need any further clarifications, you feel free to email us at info@central-bank.org.tt or call the Central Bank directly. I would just like to, on behalf of the head table and myself, I would like to thank you for your time and attention, especially those who would have joined us via the live stream. Thank you again for everyone who assisted in making today a success. We now would like to invite you, I know you've been sitting for a while, so we would like to invite you to partake in some refreshments in the room to my right. And if you have time, the governor, sorry, to my left. And if you have time, the governor has invited you to visit the museum on the way out. So thank you again.